In this lecture, we focus on farm business analysis as a management tool. We begin by explaining how business analysis supports the control function of management. Then we identify appropriate standards of comparison used to evaluate farm performance. We will define different measures of farm size and explain how size relates to profitability. Next, we outline diagnostic procedures for locating economic and financial problem areas within a farm operation. Finally, we review key measures of profitability, liquidity, solvency, and efficiency, and clearly distinguish between economic efficiency and physical efficiency. Farm business analysis can take several forms. It may focus on profitability, efficiency, and financial structure or size adequacy. A complete analysis does not look at just one indicator, but instead evaluates how these dimensions interact. The goal is not simply to measure performance, but to identify why performance is strong or weak and where corrective action is needed. Once a financial or economic measure is calculated, it must be evaluated using a standard of comparisons. A number by itself has no meaning without context. Common standards include historical performance of the same farm, averages from comparable farms, and industry benchmarks. These comparisons help determine whether current performance is satisfactory or signals a developing problem. Diagnosing a farm business problem follows a structured procedure. First, managers assess symptoms such as low profit or cash shortages. Next, they determine whether the issue stems from profitability, size, efficiency, or financial structure. The analysis then moves from broad indicators to more specific measures, allowing managers to isolate the root cause rather than treating symptoms alone. Profitability measures evaluate how effectively the farm generates income. Net farm income represents what remains from gross revenue after paying all non-operator resource suppliers. Return to management goes further by subtracting opportunity costs for unpaid labor and equity capital. This measure reflects the true economic return to the operator's management ability. The operating profit margin ratio measures the proportion of revenue retained as profit. However, profitability ratios are not perfect. Results depend heavily on how opportunity costs are estimated, which introduce subjectivity. In addition, these ratios measure average performance of existing resources, not the marginal return on new investments. Managers must therefore interpret profitability measures carefully. Farm size is an important determinant of profitability. Size does not guarantee efficiency, but insufficient size often prevents efficient use of fixed capital and labor. Even highly efficient small farms may fail to generate enough total income to support the farm households. This makes size analysis as an essential part of diagnosing low profitability. Production-based size measures focus on outputs. Gross revenue measures total sales plus inventory changes and reflects total production value. Value of farm production or value from production subtract purchase, feed, and livestock from gross revenue. Value farm production measures the value added by the farm, and it is often the fairest way to compare farms with different production systems. Size matters because many farm costs are fixed. When size is too small, fixed capital and labor are underutilized, increasingly per unit cost. As a result, low profitability is often a size problem rather than an efficiency problem. Recognizing this distinction helps managers avoid misdiagnosing the source of poor performance. Resource-based size measures focus on inputs rather than outputs. These include total farm assets, total acres farmed, labor use, and livestock numbers. Labor is often measured in full-time worker equivalence, which accounts for part-time and seasonal labor. These measures are especially useful for comparing specialized or capital-intensive operations. Efficiency measures evaluate how well resources are converted into output. High efficiency means producing more output or more value from the same level of inputs. Efficiency analysis helps explain why profitability differs across farms with similar size and structure. Economic efficiency measures the value of production generated per unit of resource. It reflects both physical production performance and price outcomes. A farm may be physically efficient but economically inefficient if prices received are low or input costs are high. The asset turnover ratio measures capital efficiency. It indicates how hard the farm's assets are working to generate revenue. Acceptable ratios vary widely by type of operation. For example, crop farms versus livestock operations. Asset turnover is a key link between efficiency and overall profitability. Efficiency drives profitability through a clear relationship. High asset turnover combined with strong profit margins leads to high returns on assets. Weaknesses in either efficiency or margins reduce overall profitability. This framework helps managers pinpoint where performance is breaking down. Operational ratios break revenue into components. The operating expense ratio shows the share used for variable costs. The depreciation expense ratio reflects capital replacement. The interest expense ratio measures the share paid to lenders. The net farm income ratio represents the portion remaining as profit for the operator. Together, these ratios explain how revenue is being absorbed. Physical efficiency measures production rates independent of prices. Examples include yield per acre or output per animal. Poor economic efficiency is often rooted in weak physical efficiency. Diagnosing physical performance is therefore a critical step before addressing financial symptoms. Efficiency is influenced by both production and pricing. High yields alone are not enough if marketing performance is weak. Likewise, strong prices cannot compensate for consistently poor production efficiency. Effective management balances both sides. Prices play a major role in economic efficiency. If selling prices are lower than those received by similar farms, managers should examine marketing channels, negotiation skills, or product quality. High purchase prices for inputs can negate strong production efficiency. Cost control strategies include supplier comparison, bulk purchasing, and buying used equipment. Diagnosing efficiency problems requires separating cost issues from price issues. Managers must determine whether poor performance stems from excessive input use, high input prices, low output prices or a combination of factors. This targeted diagnosis leads to more effective corrective actions. Profitability alone does not guarantee business survival. A farm can be profitable yet fail due to tight cash flows or excessive debt. Financial analysis evaluates how assets and liabilities are structured to identify these risks. The main objectives are assessing liquidity and solvency using balance sheet and income statement data. Solvency measures the long-term relationship between debt and equity. It reflects the firm's ability to meet all obligations if assets were liquidated. Poor solvency increases financial risk and limits flexibility during economic downturns. Liquidity refers to the ability to meet short-term cash obligations as they come due. Key measures include the current ratio and working capital. Working capital to gross revenue normalize liquidity relative to business size. One limitation is that standard liquidity ratio are static snapshots and do not account for timing of cash inflows. Liquidity problems often appear before solvency problems. Warning signs include delayed payments, increased reliance on operating credit, and difficulty covering unexpected expenses. Early detection allows managers to adjust production, financing, or marketing decisions before problems escalate. To summarize, farm business analysis supports the control function of management by comparing actual performance against standards. A complete diagnosis evaluates profitability, size, adequacy, efficiency, and financial health. Profitability measures real returns to resources and management. Efficiency combines physical performance with price outcomes. Solvency and liquidity analysis assess long-term stability and short-term cash flow capacity. Together, these tools allow managers to identify problems early and make informed strategic and tactical decisions.